Good afternoon, everyone. Thank you for taking time off this Wednesday afternoon and joining us in the ETMarkets.com webinar. Today's webinar is on the strategies for investors to face the so-called rate liftoff by the US Federal Reserve. Today, we have a very special guest, Mr. Saurabh Mukherjea. He is the Chief Executive Officer, Institutional Equities at Ambit Capital. Mr. Mukherjea, a very, very warm welcome from all of us here at ETMarkets.com. We look forward to your inputs on the rate liftoff and how it's going to affect the Indian markets. The audience, you can keep posting your questions in the little chat room on the right side of your screen. So stay logged on and start picking your money-making ideas. Over to you, Mr. Mukherjea.
Thank you. Thanks for hosting me here. The potential, what does that mean? Data here, we're going cut down. Right. With the data over the last week, that interest rates and the US 5-year, 10-year bond yield starts rising, money flows into emerging market equities. Right? When, I stress again, all the data unquestionably shows that when the US Fed starts hiking interest rates, simple reason being, rate hikes in the Western world put pressure on Western bond prices. Money flows out of bonds into equities, equities of all countries and all kinds. Emerging market equities is a natural beneficiary of that. That's the history. Will that replicate itself this time? It might not. It might not because on the back of QE, on the back of the Fed expanding its balance sheet by that record $3 trillion between September 08 and July last year, because of that $3 trillion of expansion, money clearly has already moved into risk asset classes, whether it be EM, whether it be real estate asset classes in large quantums. And hence, it's not obvious that there's any extra money that will suddenly come into India just because the Fed hikes. Where I think the debate is somewhat misplaced is seeing the rate hike, seeing the lift off is a specific event. I think what's already happened over the last year or so is as money becomes dearer, as the cost of funding rises in the Western world, basically the US 10-year bond yield rises, you can already see the pullback of American money in particular from risk asset classes. I think emerging markets as an asset class, is off a good 40-50% over the last 2 years. Commodities are off more like 60-70% over the last 2 years. I think in the last 2 months, we've already had 2 IPOs in America, which have gone public at valuations lower than the fourth round PE funding round. The golden era of emerging markets investing, I think we can safely say, is behind us. Global emerging markets as an asset class, I think, will be out of favor for some time to come. If you look at global emerging market equity returns, they are negative on 1 year, 3 years, 5 years, and 10 years. Now, when an asset class doesn't deliver over 1, 3, 5, and 10, broadly speaking, I think that asset class goes out of favor quite rapidly. I think that is currently the fate of global emerging market equities. Now, what does that mean for our market? I think as we have seen over the last 5-6 months, I think FII outflows in equities are likely to continue. Over a longer period of time, over the next 2-3 years, Indian equities as a standalone asset class will gradually start emerging. But the bulk of equity inflows that we've received as a country was not because of Indian equities as a standalone class. We used to receive inflows as part of a GEMS fund. The GEMS funds are under enormous pressure. Hence, FII inflows driving the Indian market, I don't think will happen for some time to come. I would say over 1 or 2 year period, it's highly unlikely that FII inflows will drive the Indian market. So what are you then left with? What will happen to our market? I think FII debt flows have been strong and will remain strong. I can't see Indian interest rates falling rapidly. At most, it got 100 basis points of rate cuts over a 12-month period. And as a result, if the currency holds up, we now give the global debt investor a healthy return. You're giving 7.7% on 10-year bond yield. And even if that falls to say 6.7% a year, hence, with the rupee stable, 6.7% is something that the FII debt investor will happily take compared to the negligible returns you get in the West on fixed income investments. So FII debt, I think, will become more relevant than FII equities. Indeed, that's already the case over the last 12 months. FII debt has already become far more relevant than FII equities. In the golden era of GEMS funds and hence of FII inflows will abate for a couple of years. Indian equities will have to emerge as a standalone asset class. That will take a couple of years coming. For the Indian stock market, therefore, I think the outlook is is muted. It's muted because of the FII flows picture. It's also muted because of our own domestic economic circumstances where for a good 4 or 5 quarters we've not been able to grow earnings. So the combination of the core investor in the Indian market, foreign investor conking off, and large corporate earnings simply not coming through quarter after quarter will mean that the stock market's outlook is reasonably muted. How do you as an investor then react to that? I think the answer to my mind is reasonably straightforward. You have to go down the market cap spectrum. You're looking at small and mid caps, and you're trying to buy high quality small and mid cap companies, well run companies, cash generative, what I tend to call good and clean companies. So happy to take questions if there are any.
Well, thank you, Mr. Mukherjea. That was a very enlightening session, I would say. And some real interesting points seem to have come out from that short presentation of yours. Now, for the audience, I would like to reiterate that Mr. Mukherjea is ready to take your questions. You can open your chat room on the right side of the screen and post your questions now. You can also tweet us your questions on the ETMarkets handle. I'm sure you are following us on Twitter, and do follow us there. The first question, Mr. Mukherjea, that comes is from Mr. Avinash Kumar in Gurgaon. Mr. Kumar asks, if the US hike is done, is the FII activity slowing down in emerging economies like India? So his question is, will mutual funds also slow down their activity in the market? And he says that his company, there are annual results lined up soon. What is your input to that?
Right. So I think some of the answers to those very thoughtful questions are already in the data, so to speak. If you see the FII flows, equity flows over the last 6 months, I think it's been net outflows over the last 6 months, net equity outflows of the FII fund over the last 6 months have been to the tune of $3 or $4 billion. So the FII money, FII equity flows are clearly negative. And as I said in my address, I don't see that changing in the foreseeable future. Now, clearly, so far, the negative FII outflows have been counteracted by positive domestic inflows. Partly because I think domestic investors are seeing financial markets, financial products as a viable alternative for the first time, thanks to Raghuram Rajan creating an environment where we can actually get a positive real interest rate in India. This is the first time I can remember in the last decade when we've been able to get a positive real interest rate in India from investing in FDs. So thanks to Rajan's hawkishness on inflation, we've got a positive real interest rate. We've got retail savers putting money in financial markets. That in turn is flowing, part of that is flowing into equity markets and holding equity markets up. What's also helping markets is the fact that real estate is in bad shape. I think real estate is a really stressed asset class in India. And as savers, as high net worth individuals shy away from real estate as an asset class, that's bringing money into our mutual funds, into our stock market. Now, so far, the FII outflows have been broadly cancelled out by the domestic inflows, and the market has broadly held up at the 25,000 Sensex or Nifty 7,800 odd levels. I'm not so sure how sustainable this is. My reckoning is that some stage the retail investor in India, the high net worth investor in India, will throw in the towel. They'll pull away from the stock market because the stock market over the last 12, 18 months hasn't really given a meaningful return to the retail investor. And whether we like it or not, most retail investors do look at the last 12 months of returns. If the retail investor pulls away, the Indian market is fairly fragile. And my reckoning is a 10-15% fall in the Sensex will happen quite easily if retail investor demand dries up, which I think is a reasonably high potential of over the next 12 months.
Okay.
I hope that answers the question.
That does answer the question. So there is a certain Mr. Vijay Srinivasan. He's written to us from Coimbatore. So he wants to know how far and deep will the extent of the fall be, the post Fed rate hike.
Just to stress again, I don't see the specific event of the Fed rate hike as being a sort of momentous event or a disastrous event. I think the rate hike has been telegraphed so far in advance that I think by and large the specific event has been factored into the market. What I'm getting at is over a 12-month period, over a longer period of time post post the rate hike, I think there's a reasonable chance of the market, of the Sensex coming off by 10-15 percentage points, which would take it to 22,000 on the Sensex. So it's the 12-month outlook for the market, which combines the perspective on FII flows, which is quite negative, which combines the perspective on corporate earnings, where also there isn't anything particularly positive there, and joining the dots there suggests that the outlook for the market isn't anything as cheery as the sort of happy consensus that you tend to read about in the newspapers.
All right, thank you. Mr. Surendra Chauhan writes in, he has a corpus of worth 20 lakhs and he wants to make an investment. So he's asking for advice. He's asking which sector, according to you, will have an impact in the long term, and which sector do you think will recover in the short term so that he can buy into that sector?
So let me leave the short term aside, because honestly, in the short term, it's very difficult to make say anything particularly helpful. More often than not, I try to make short term calls, I get it wrong. So let's look at the long term. I think there's two or three areas which are two or three sectors, unfortunately small cap sectors, but two or three sectors nevertheless which will do well over the next 2-3 years. The first is road building. I think it's reasonably clear that this government has prioritized road building. My hunch is that the budget in March will again hear of a big jump in government capex on road building, and hence well-run road companies should be well placed. These are EPC contracts where the government of India provides the money and a private sector builder builds the road and collects the money from the government. I think that construct has worked well for NDA over the last year and a half, and I think they'll ramp it up further in the budget. So road building as a sector, road EPC, as we call it, the sector, I think is reasonably well placed. The second sector worth looking at, I think, is transmission distribution, because what the Prime Minister has said several times, and in fact he gave the target first in his Independence Day speech in 2014, and then he preponed the target in his 2015 Independence Day speech of getting electricity into all villages in the country. So the Prime Minister realized that from a political perspective, it's a great idea to get electricity into all the villages in our country, and he set a very aggressive deadline for that. Now, my reckoning is this will lead to heavy investment by the government, by the central government, by state government, by DISCOMs on transmission and distribution. So T&D outlay on transmission lines, substations, transformers, I think spends on those items will go up substantially over the next 2-3 years, and hence the entire transmission and distribution sector is worth looking at. The third sector I would look at with interest is organized retail. Historically in our country, retail rentals have been so high that it's actually very difficult. It's historically been very difficult to make money from retail in India. With the odd exception of, say, a Titan and a Jubilant Food Works, we really struggle to see Indian retailers making money. My reckoning is that situation is about to change. My reckoning is retail rentals are coming off, retail rentals are becoming affordable, our cost of capital is coming down in our country, and the combination of lower cost of capital, lower retail rentals should allow the organized retail sector to actually become profitable properly for the first time. So I know several listed retailers who are reasonably well run, reasonably clean companies, but they've never really made any significant profits. So my reckoning is the outlook for organized retail will improve meaningfully in the next 2 to 3 years. So that's where I would look. I would look for pockets of activity in our economy where you've got say 2 or 3 good companies in each of these sectors, in T&D, in road building, and in retail, and I'll try to cherry pick those opportunities in a market where I honestly don't see the frontline indices giving us much joy over the next couple of years.
Okay, thank you for that. Staying on that tune, Ajit Nambiar has written from Dubai, so he wants to know how is it going to affect the pharma stocks. I'm guessing that Mr. Nambiar is interested in pharma, and he's probably made investments there.
So I have to sort of disappoint Mr. Nambiar at one level by saying that the drivers of pharma stocks, the main driver of pharma stocks in India, unfortunately, has become the US regulator, the FDA. Neither our government nor the companies themselves are able to actually help that much, help you or me that much in terms of understanding what will happen to the pharma sector in our country. So what we have seen over the last year and a half is, heavy FD activity in terms of sending warning letters and shutting down plants run by large Indian pharma companies. And I have to confess, I haven't found any way of predicting which is the next large Indian pharma company where the FDA will shut down 20% of the production or send a warning letter. In that sort of scenario, I think pharma has become an unpredictable sector. And over time, my reckoning is pharma will derate as the scale and persistence of the FDA in terms of trying to crack down on Indian companies who are lax on compliance as that continues. Remember, a year and a half ago, the FDA moved from a announced check regime to a surprise check regime. A year and a half ago, the FDA would call you up and tell you that 15 days from now, we'll come and inspect your such and such plant. But then they shifted to a system where it was surprise checks, and as soon as they shifted to a surprise check system, Indian companies started finding themselves on the wrong side of the FTA. I'm afraid that hasn't changed. My sense is that compliance costs for Indian pharma company will rise sharply in the years to come. But even before that happens, I think that they will face much more disruption from the FDA. So it is a sector where I have to confess I'm not able to sort of second guess the US regulator here.
Okay. And from pharma, I move to banking. Mr. Bhaskar Agle from Bengaluru writes in. He has invested in HDFC Bank, Axis, and SBI for the long term. So he's asking for advice. What should he do now? Should he get out, or should he just and buy later, or should he just sit tight right now?
So these are actually very different companies. I'm not going to talk about stock specifics because I don't think it's fair to talk about stock specifics in a forum such as this. But the point I will make is, you in the three stocks you mentioned, one of them is a housing finance company, and the other two are banks. And even amongst the two banks, one of them is a primarily retail-oriented bank, and the other is a bank with a heavy commercial focus. So these are actually three very different companies, and I think the only sort of common theme is financial services, but that isn't particularly sort of helpful in explaining the futures. As you might have sort of heard or read what I've written elsewhere about the real estate market, I remain convinced that big city real estate in our country is overvalued. I think considerably overvalued. And obviously, if big city real estate comes under pressure, real estate prices come under pressure, I think housing finance companies of all shapes and sizes will face the consequences of that. These consequences might be a slowdown in loan book growth, deterioration in asset quality, and hence pressure on profitability. But a natural corollary of a real estate correction in India, which I think is overdue, would be pressure on housing finance companies. The banking sector also has at least, I would say, 20% of its loan book exposed to real estate. The RBI data suggests, I think, 15%. I think the banks don't count certain assets as real estate linked, which in fact they should. So SME lending is in fact heavily linked to real estate. So if I add SME lending into real estate, banks have something like 20%, at least 20% of their loan book exposed to real estate. So real estate pullback will have impacts on banking. But over and above that, the challenges facing corporate India, the consistent inability to improve profitability in corporate India, I think will also have a bearing on banks' credit quality. And the final piece that I think will create challenges for Indian banks is the fact that the RBI governor has created, I think, 25 banks over the last 12 months or so. So if you create 25 banks in 1 year after not creating any banks for 12 years, right? For 12 years, we had not a single new bank in our country. And then suddenly we have 25 new banks. That's bound to put pressure on the profitability of large private sector banks. It's astonishing that the private sector banks haven't derated in the light of the governor's 25 new bank licenses, given that it will be one heck of a miracle if profitability of the frontline private sector banks does not erode materially as these 25 new banks ramp up over the next 3-4 years.
From that banking snapshot in India, now we move to the US. So Chiranjeevi Chakraborty writes in from New Delhi. He wants to know. He says that the US 10-year T-bill yield have been muted in this year in 2015. So he asks, do you think that the market may not have fully priced in a hike or the path of the hike yet?
I think what's happening in America, this is what I read and what I hear from our clients. What's happening in America is the point of view that hey, we might do a hike in December, but given how fragile the U.S. recovery is, we can't hike rates, that many times. So hence the rate hike that will happen are being presumed to be, say one or two, and basically the market's factoring in a very modest bout of rate hiking by the Fed. I have no reason to disbelieve that. I think if you guys go online, Larry Summers has written a very good piece in the FT, the Financial Times, I think 2 days ago, about why America can't really afford too many rate hikes. So that's leading commentators to presume that the Americans that there aren't that many rate hikes coming, and I don't have any reason to disbelieve that point of view. But as I said, what the markets already started discounting over the last 12 months is the fact that that extraordinary period of balance sheet expansion by the Fed is behind us, where over the course of 5 years, the Fed printed $3 trillion. That's behind us, and as you take away that easy money that the Fed had pumped around the world, as you take that off the table, gradually liquidity is receding. As liquidity recedes, the bubble-like situation that had emerged in commodities, in some emerging markets, in private equity, dot-coms and asset class, that starts subsiding. So even if rate hikes in America are modest, and that's what the market is expecting, I think this journey will continue where sort of the incredible speculative excesses created by the Fed's QE will gradually start dissipating, and perhaps one or two bubbles will in around the world.
So, are we going to see? Do we see a hike of 100 BPS in 20? That's a very pertinent question, which is coming from Amit Mudgal.
No, I think that'll be too much too quickly for America. I doubt the American economy can live with 100 bips of hikes in 2016. I think that'll be a bridge too far for America. My hunch is that they'll hike by around 20 bips in this month. That's what the consensus view seems to be, that they'll hike 20 bips next week, I guess, and then another 50, 60 bips over the course of the next 12 months. It's very difficult to see one short 100 bips, a 1 year period where interest rates run up by 100 bips.
Okay, just to reiterate once more, we have like around 150 questions in the queue, so I will have to be a little choosy right now, and I will be picking only the best and the most pertinent ones. So my apologies to those in advance whose questions I will have to skip. We will probably take your questions the next time. And coming back to the webinar, Mr. Mukherjea, the next question has come in from Rishi Raj from Pimpri. He writes in to ask that what should be the RBI strategies to cope a liquidity outflow? And if you could just explain that.
So I think what Raghuram Rajan has done, and he's articulated this reasonably clearly in his public statements. He's been fairly forthright in saying that when the world unwinds, when QE is unwound, and I think he said this several times, when QE is unwound, emerging markets will face a day of reckoning, especially with a special focus on currency pressures as QE is unwound. And I think, given how much he's talked about the after effects of the unwind of QE on EM, one has to presume he's prepared for this reasonably well. Now, I'm not privy to the specific tactics, but my reading of what the RBI has done seems to be that create a massive FX reserve, which they have done. I think FX reserves have augmented by a good $70–80 billion since the current governor took charge 2 years ago. So create a massive FX reserve surplus. And second is create a big interest rate differential vis-a-vis the Western world, so that interest rate differential itself deters too much downward pressure on the rupee. I think that the RBI's twin strategy to protect the rupee seems to be have a huge war chest that you can deploy to protect the currency, and secondly, have a juicy interest rate differential, which will keep the FII debt investor interested in pumping money into India. Beyond that, I'm not so sure what else the other strategy would be, but of all the central bank governors in the world, Raghuram Rajan has been the most articulate about this, about the risks posed to EM as QE is unwound, and I presume, given the man's acumen, he's prepared for this very well.
Yes, we agree with you that Mr. Raghuram Rajan has been most articulate. There is another question which is coming from the IT city Bangalore. Mr. Tehmas Mogul writes in that he wants to know why would the US firms sell their Indian assets, which perhaps give them better returns than the options that are available in the US markets these days, and where would they invest the proceeds that they can that they are going to encash?
So I think it's worth just looking into that. I think that the point of view that's been articulated in the question has traditionally been the point of view that we in India held on to, that we offer better returns to global investors than their own economies offer. The problem with our country has been 6 quarters now we've not generated any earnings growth in our economy, right? Whereas in that 6 quarters, US earnings growth, right? This is a country with much lower GDP growth, but US corporate earnings growth has been meaningful, and that's where investors, foreign investors, started losing faith in India, saying that why should I invest in a market which is valued at 18 times trailing earnings, but doesn't generate earnings growth, when back home in America, I am getting earnings growth in a market which is much cheaper and where I don't have to contend with currency risk. I think that's been the core problem with our market. And also, if you look back, right, over a 5-year period, or indeed over a 10-year period, in dollar-adjusted terms, we haven't really outperformed the US markets. Remember, 5 years ago, the rupee was at 45 to the dollar. It's now 67 to the dollar. So adjusting for the slide in the rupee, I'm sorry, we haven't outperformed the US markets, and that's where I think the FII investment into India and indeed into EM. I think EM is a similar story actually. The FII investment story into EM and to India is hitting a roadblock, wherein the FII himself can't justify to his own investor, which could be a pension fund in California, as to why on earth do I put money into the Indian market, a country where corporate earnings don't grow quarter after quarter.
So, do you believe that there will be a further downside? Mr. Ramesh Iyer from Chennai, he wants to know, and he also wants to know if the downside will only be for a short while.
So I think, as I said in my main address, my reckoning is that over a 12-month period, the market will struggle to give double-digit returns. The Indian market will struggle to give double-digit returns over a 12-month period. Or let's put it another way, it's hard to envisage double-digit corporate earnings growth over a 12-month period. Now, will the market fall violently? That's not my central scenario, but given the risks around our banking sector, which is in bad shape, given the risks around the real estate sector, which is overdue a correction, I think there is a reasonably high possibility of this market cracking by 15-20% over 12 months. But my central scenario is that we see single-digit returns at the market level over a 12-month period.
So, Mr. Rajendran Vasudevan writes from Karunagapalli. He wants to know, is there a probability of a reversal like that in Sweden and in the other European nations? Once the growth momentum shows signs of going astray, is there a possibility of the reversal syndrome being at work?
I think look what's happened in Europe, where the core idea was to cut rates. Until I think in the case of the Swedes, the currency came under pressure, and perhaps then they went the other way. I'm just thinking at the top of my head. given the state of economy, the idea was to cut rates, and then in Sweden's case, the currency went the other way, and then they reversed the process. I think where there is risk around interest rates in our country, I think food prices have picked up again. My reckoning is, from what I've seen in my travels in North India and what I'm hearing from agri experts, I think the Rabi crop is in bad shape. Like the Rabi crop could fail. Planting of wheat has been below normal. Beyond wheat, other Rabi crops like barley, gram, mustard. I think there's real concern around that. So if the Rabi crop fails, food inflation will pick up pace over the next 3-4 months. And as that happens, that obviously reduces the prospects of further rate cuts. So like me, most people are expecting around 100 bips of rate cuts from the RBI over the next 12 months. My reckoning is there's scope for disappointment there, given what I'm hearing on the Rabi crop.
Mr. Mukherjee,
if you don't mind, just one last question. I need to shoot off after that.
Okay, we are clearly running out of time, so there's one last question that's coming from Vijay Saikia. You're known to have predicted the 2008 financial crisis. So when or what, in case, is your next doomsday prediction, if there is any?
So look, on financial crisis, the book worth reading is John Kay's book, Other People's Money. I think the book was published 3 or 4 months ago. It's an outstanding book on financial crises over many decades. And the clear takeaway from John Kay's book is that you've got another financial crisis coming globally because of the highly accommodative policies of the Western central banks. With regards to our own country, what worries me the most is that we've got a banking system where 13% of assets are stressed, and that's before real estate has started correcting meaningfully, and that's before the steel sector has actually properly got into trouble. The steel sector, I think, is heading for trouble because our steel prices are uncompetitive in comparison to Chinese steel prices. Steel accounts for generally metals account for 10% of banking system loans. Real estate accounts for at least 20% of banking system loans. And even before these two sectors are in proper trouble, we are already struggling in the banking sector. Now that's where my concern arises, that our banking system is in bad shape. I'm not being able to see a policy response which convinces me that the powers that be really have a grip on the situation, and combine that with an overvalued real estate sector. My worries about India are actually more pronounced than they've been in the 8 years I've been living in this country. So I think I'll end on the note saying, be cautious with your investments. This is a very tricky economy at the moment. It's a tricky situation in the stock market. If you are investing money in the market, make sure it's money you can afford to lose. Make sure it's money that you can do without were the market to get compressed for a couple of years. And last but not least, do stock picking. Be careful with your stock picking. Go for high quality, well-run companies, strong balance sheets, strong cash flows, promoters with credibility and clean management structures. Yeah, I'll take leave. I think I'm being summoned elsewhere, so I'll take leave. I thank you, Reena, for hosting me, and thanks to all of those people who logged in and asked their questions. Grateful to all of you.
Okay, thank you, Mr. Mukherjee. That was so that's a word of caution coming in. Need to be cautious and need to invest wisely. Thank you, lovely audience, for your patience and cooperation. And we apologize to those whose questions we were not able to take. Do join us for a captivating session next time. Thank you.